So in this video, we're going to be doing some Betfair trading on pre-off horse racing. We're going to be trading using order flow. And order flow is the process of looking at the market, assessing where the money's coming in and out, and then seeing how that's creating a path of desire in the market. And then we're nipping in ahead of that and trading out before the race has started. It couldn't be easier. Now, of course, a lot of people will say, well, it's not that easy. But sometimes when you're trading order flow, the market will tell you absolutely everything that you need to know. I've been successfully betting and trading for over 2 decades. If you want more videos like this and you want me to describe more of what I do, then give us a like. If you want to talk to like-minded people, visit the Betangel forum where you can do exactly that, but also visit our website where you can download a free trial of Betangel. So trading order flow is making an assessment as to where you think the odds will go, and you're going to be doing that by looking at the market and assessing where the backing and laying activity is. Fundamentally speaking, the way that exchanges work is if you actually place an order into the market, that takes a chunk of that market out. And if there isn't much left for the next order that reaches the market, then the price will move. So if you see somebody continually backing something, that will pull the price in. And if you see somebody continually laying something, then that will push the price out. And order flow trading is about picking up on those patterns, seeing where the general trend is within the market, what impact that's having on the market. And you tend to focus on one particular runner, but you have to take into account some of the activity that's taking place elsewhere. But fundamentally speaking, when you're trading order flow, you're just making an assessment as to how all of the money that's coming through the market is affecting the price. So one of the key characteristics of a betting exchange is that they have an open order book. You can see all of the orders up and down each side of the ladder. You can see the amount of open interest within the market, and you can see how much there is available to back or lay. So if I went into a market and I wanted to back or lay with £1,000, but only £500 was available, then I would take out that entire amount with the stake that I've put into the market, and then the order would sit there waiting to get matched on the other side. But the most important thing from our understanding is that if we backed or laid something with £1,000 and there was only £500 available, not only would we wipe out that amount of money that's available and sat there waiting for us to take, but it would necessarily move the price. And this is the sort of key thing that you look at and try and understand when you're trading order flow. How much money is coming through the market? What impact is it having on the amount of money that is waiting at the current back and lay price? But also you'll get some clues by the amount of money above and below the current price as to exactly what's going on in the market. And that's the key to the trade that we're going to do here. So when you turn up to a market, you would necessarily look at the charts first, just to give you an idea of where the price has come from. What has the market been doing up until this point? But you really need to switch to the ladder to have a good look at the market, because the ladder contains the full market depth of the entire, all of the orders that are open in the market, where they've been traded, all of that sort of information is available on the ladder. So I'm going to bring up the ladder on this particular market that we're looking at, and I want you to have a look at that and sort of have a think about what you can see that is of some level of significance here. Because what we've seen on the chart is the price started at a higher price, it gradually moved down, and then it sort of got stuck in the market, and it hasn't really moved since then. And we can see the reason why that has happened on the ladder, because there's £18,000 waiting to get matched at 4.5. So in order for the price to head up beyond 4.5, it's going to take more than £18,000 worth of lay orders in order to be able to push past that. It's basically going nowhere. That's why the market is flatlined. And for the price to go down, it basically just needs a little bit of money. You know, there's a massive imbalance here, so it only needs a little bit of money to pull the price in. And if this person is really trying to get this order matched, then in order to get it matched, they're going to have to move the price down to try and get as much of that order matched as possible. So yeah, we can look at the chart, that tells us a little bit of a story, but when we look at the ladder, that can give us the full story. So in this market, we've already seen the money in the market, and it's gradually moved the price down, and it's sat at 4.5. So in order to get active within this market, I opened my trade by putting my order in just below it. Why have I done that? I'm happy to take the money out at that particular price. Well, if this person really wants to get this order filled, and in this market, and based upon looking at the market for a short period of time, I think that they do, they're going to have to move their order below mine. And if they move their order below mine, I can basically trade out for a profit. Now, when you see this, it's not impossible that it could be manipulation, but that is not, I mean, it does happen, but it's a lot less common than you would think. And if you sit and watch the market for a while, you'll be able to see somebody put an order in the market. You'll see that money getting taken by looking at the numbers and the detail on the side of the ladder where all of the volumes are displayed, and then you can see them moving it. So if they move it and it gets filled and they keep moving it in order to get filled, then you can be pretty certain that this person wants to get a large back order in on this particular horse. It could happen in both directions. It could be a late order, it could be a back order, but basically if somebody's trying to get a large back order filled, then you would basically open your position just below it. If it were a lay order, you'd do the opposite. You'd put your order in above it, because what we're doing here is we're sort of saying this person wants to get matched. We know if they want to get all of that money matched, because it's so much bigger than the rest of the market, they're going to have to keep moving the price down. And of course, when you're actively trading, you can take advantage of that. You can basically open your position just in front of theirs, and as they move the price down, then you can actually put your closing positions in to cash out for a profit. So that's exactly what we've done on this particular occasion. Now, of course, what you've seen in other videos that I've done is I tend to build positions. So I will have in my mind an idea of how much money I'm willing to commit to this trade. If I'm very certain about what's going to happen, I will use larger stakes. And if I'm not so certain, I reduce my stakes. It's a good way of managing your risk in a trade and minimizing your losses. But of course, as I build a position in the market, I'm going to start putting those closing positions further down the ladder to a place where I think that they've got a good chance of getting matched. And my trade management on a position like this would be, if those orders aren't going to get matched, I would just move them up to get matched at the best available price. But yeah, as soon as I open that position, my closing positions go in, and I'm trying to establish a decent position on this particular trade, but I'm managing my risk by putting those closing positions in straight away. Not only does that help me balance out the risk, but it also gets me near the front of the queue on those closing trades. Now, as the trade develops, we end up again that they get their order filled a little bit more, but they still don't have all of it filled, so they pull the price down again, and they've got £11,000 left at 3.8. So you can see that this person really wants to get matched. And when we see that from a trading perspective, it can present us with an absolutely brilliant trading opportunity, one that's almost certain to work. And all we're doing basically is following the money. We're not doing anything cleverer than that. We can see their open order. It's not ambiguous. It's not a gentle flow of money in and out. It's a stark, outstanding order. We can see what they're doing with it, and we're just benefiting by being in front of it. So at the end of this trade, you can see that we actually ended up with a decent total. And this was basically just following that money. We didn't do anything cleverer than that. And then, of course, just before the race starts, we hedge that position to get a net profit, regardless of who goes on to win. So when you're trading order flow, what you're trying to do is make an assessment as to where the market is going. You're looking for the path of desire. Typically, it's not like this. You don't tend to see one big chunk and then the price comes down, but it's a good illustration of the sort of thing that you're looking for. But in a normal market, what tends to happen is it's the culmination of many people doing this that is gradually pushing the price in or pushing the price out. On this particular occasion, this person, whoever it was, whatever they were trying to do, just wanted to get a lot of money on this particular horse. And the only way that they could do that on the exchange to get a very large order filled is to keep taking a slightly worse price. That's the only way that they could get this particular order filled. It can work in both directions, but fundamentally speaking, because of the way that the exchange works, every time that they try and get filled, if they wipe out the amount of money that's available at that particular point within the market, then the price must move. If you're looking at conventional markets where you don't have a big player in the market, then it's the same sort of thing, but it's just a gradual accumulation of money. That's typically how you would trade order flow. But this was a great example this week of exactly that sort of process in place, and one that was very easy to understand.